Hello, everyone. My guest today is Paul Lappas. He is the CEO and co-founder of Intermix.io. He holds multiple patents for cloud computing and performance analytics. And in 2007, he co-founded GoGrid, one of the early cloud computing companies, which he grew to over $50 million in ARR. Paul, are you ready to take us to the top?
I am. Thanks for having me.
You bet. Okay, that's a big cliffhanger. We have to finish out the GoGrid story before we talk about Intermix. What happened to the company?
The company got acquired.
Who'd you sell to?
In 2011 by DataPipe, a big data center cloud provider. Yeah.
What was the ecosystem like back then? Yeah. So, I mean, was it a good exit or a soft landing or what?
We had the opportunity to blow it up to be much, much bigger if we had taken on a lot more capital. It's very expensive to build cloud services, but we were really, really happy with the outcome.
That's great. All right, Intermix. So did you go directly into Intermix after GoGrid, or if not, what was the in-between story?
So I spent a couple of years consulting with a few companies to help them bring their products to market. You know, I had focused on technology at GoGrid, and I really wanted to spread my wings and learn more about other sides of the business, marketing and sales. And so, I sort of was helping some other startups. I landed in 2013 in how I got the idea for Intermix at a company called Crittercism. It was later renamed to Aptelligent. What
Much
we were
better
doing
name.
was a crash reporting tool for companies developing mobile apps. And it was super big platform. We had a little library that ran on over 1 billion devices across Apple and Android. And what was really interesting about the company is that we were sitting on a ton of data. For example, we could tell you for Android how many activations were done on the AT&T network in Los Angeles in January because of the data that we had. And it wasn't part of what we were selling, but my co-founder, Lars, that had joined Intermix at the same time as me, that's where we met, approached me one day and said, "Hey, can we put this data into a place where we could sell it? I have a few companies that would be interested in buying it, some private equity firms, other consultancies that were just interested in this industry data that was really hard to get." And so I said, sure, how hard could that possibly be? And I hired a data scientist to help me to do that. And almost immediately when that person joined, they were like, "Okay, great. Where's the data?" I was like, "Well, it's here. It's in all these databases, just go out and find it, And he's like, "No, I need to have it all in one place. It needs to be clean and complete and correct. And I need to be able to run my tools on it, my specialized data science tools." And I said, "Okay, interesting." And then I spent 3 months doing that and getting the data to a place where it was useful. And really, at the time, I talking to other peers in the industry, realized that a lot of companies were having the same challenge in making data scientists successful. And so, decided to leave that company, and Lars and I joined up to start Intermix shortly after that.
Lars was the data scientist?
No, Lars was the head of business development at Crittercism.
Did you bring the data scientist with you or no?
I did not.
Come on, Paul.
No. Well, you kind of, people that you would hire later stage are different from people that you need to start a startup.
He's such a diplomat, smart guy. All right, talk to me about how people can pay. We understand the product, I think, because you just give a great story. Tell us how you monetize. Is it a pure play SaaS company?
It is. Yeah, it's a SaaS company. We sell to enterprises. It's a subscription, and people will either prepay for 1 year or 2 years.
Okay, so on average, I'm sure you have a lot of cohorts, but we're short on time. What would you say like an average company might pay per year to use your tool?
It's between 5 fingers, moving up to 6 fingers, to 6 figures now.
Okay, got it. And that's kind of first year ACV. So call it maybe anywhere between 50 and 100 grand.
Yeah.
What do they? Yeah. So let's role play for a second. If I sign up today for 50 grand, give me a sense. Paint a picture here. What would I get for that?
So what you get for that is a single dashboard whereby your data teams, the ones that are building out your data lake infrastructure, that your data scientists plug into, you'll get a single view into all the apps that are connected, all the users that are running queries, the way that data flows through that system, and a very, very easy and quick ability to figure out, is everybody having a good experience? Are apps working? Is the data lake working? Or if not, why and what the root cause of that, so that you can very quickly pinpoint where data is getting stuck.
Interesting. Okay, very good. And put this on a timeline for us. So what was the official year you launched?
So we launched at the end of 2016. And one of the interesting things, Nathan, is that we got to revenue, our first dollar of revenue came only 6 months after we wrote the first line of code for the business.
I love that you lead with that. It's like a technologist who says, you know what, all techies don't just only focus on product. We made money after 6 months. well, sorry, maybe not made money. You had revenue in 6 months.
Right.
That's great. I want to get the story behind that first dollar in a second, but let's go backwards. So today, how many customers have you scaled to?
So we now have over 25 customers. We're still a seed stage company, Nathan. So we're still quite small, and we're approaching $1 million.
What do you mean when you say you're still seed stage? How do you define that?
So the way that I define that is we're still, we have a lot of revenue. We have good customers. Our churn is really, really low. It's
how low?
Tiny. It's we're over 100% revenue retention because a lot of our customers will expand with us.
What about gross churn though? If you peel back that onion.
So our platform is focused on Amazon Redshift right now, which is a major cloud data warehouse.
Yep.
So as companies shift to other data warehouses, they might churn off of us.
I see.
Snowflake or BigQuery. Yeah. And so our vision is to support all of those databases going forward. But for right now, we're small.
So I mean, is that code for like maybe 10-ish annual revenue churn on a gross basis, or like what is churn today annually? Gross.
It's under 5%.
Oh, I mean, that's super healthy. Okay. So you lose less than 5% of your revenue annually. You more than expand that same cohort by 5%. So you have net revenue retention north of 100% at this point.
Yes.
That's great. Okay, yeah, take me back to the backstory. So you said define seed stage, and I said, how do you define that?
Yeah, well, we're at the point where we're still figuring out the right go-to-market, right? What is the best way for us to acquire a dollar? Can we make at least $3? Can we make that money back within 1 year consistently, and have enough data points where we can go to an investor and say, hey, if we million of your dollars, we'll be able to grow at this rate over the next 2 years. We're close to that at this point, but we're not quite there yet. So we're still at that stage of the company.
Have you capitalized the company? If so, how much have you raised to date?
We've raised a little bit over $5 million across 2 rounds of funding.
And why did you decide to raise instead of bootstrap? It sounds like you're able to get revenue going pretty early.
Yeah. Well, when you're building hard tech like we are, you need software engineers, and software engineers are expensive. And so
are you all in San Fran?
I'm sorry?
Are you guys all in San Francisco?
Not all. HQ is here, but we have engineers in New York and Europe as well. So we're distributed.
And how many people total?
9 people total.
9. Okay, that's great. And then look, I mean, if I take the 25 customers, right, times, we'll stay on the minimum side. So let's say $50,000 ACV. I mean, you got to be either flirting or just past kind of the $1 million ARR mark. Or is that something you're going to pass in the next couple of months?
Yeah, we're going to pass that in about Q2. That's Q2
great.
Time period.
That's great. Yeah, and can you give me a general sense of growth year over year? So if you're at, call it $70,000 a month today, where were you a year ago?
So, I mean, we're growing at over 12% per month at this stage, Nathan, adding new customers. Not only are we adding new customers, but the ACV is also growing, and our expansions are approaching over 30% of our monthly growth at this stage.
You mean a lot of your revenue growth is coming from expanding old cohorts that signed up?
Yeah. So customers will renew and they'll double down. They'll increase their ACV. And also the way that we bill is a function of how much data our customers are processing. And the thing that's true for everyone is they're processing more data, they're storing it for longer, they're doing more things with it. And so our pricing goes up as a function of how much data they're crunching.
So Paul, with 12% kind of monthly growth, I mean, that's, obviously north of 100% year over year. I mean, fair to say you were doing maybe call it 25, 30-ish grand a month a year ago, something like that? So you've more than doubled?
Yeah. We're more than doubling every year easily.
Yeah, that's great. Yeah. Talk to me about, so the last tranche of funding, you said you did it in 2 tranches. When was the last tranche raised and how much was it for?
We raised a round in May, led by Encore Capital. That was a $3 million seed round.
Okay, and you had kind of a thesis or a pro forma built out on how you deploy that capital. We're now several months into that. Has it panned out how you thought it would? And if so, if not, where's it different?
So it is panning out. The thing that is the most exciting is that we've recently gotten traction in the enterprise. Very large Fortune 500 companies are now using us as part of their digital transformation. So when large enterprises shift their data services to the cloud, they experience a lot of pain, and we're there to help them make that transition away from the traditional data warehouses like Oracle and Teradata. And so we've been really excited to find that niche for ourselves, because obviously those are much higher ACV customers and a much better market segment for us.
Yeah. Do you have enough kind of a large enough sample size yet to have a good understanding of what your CAC is, or is it too early?
We do. Our CAC at this point is south of 10K. The nice thing about our business is that we can sell it over the phone. Typically, customers will make a decision. There's a free trial, and they'll make a decision in about 2 weeks, 2 to 3 weeks, of whether to buy us. So our end-to-end sales cycle is south of 2 months at this stage, even for the larger customers.
So $10,000 CAC on, call it a $50,000 ACV account. You guys are what, 3-4 month payback period, something like that?
Yeah.
I mean, look, obviously that's healthy. Are you generally getting more aggressive with that or less aggressive?
We constantly want to try to increase prices. We always want to make sure that we're adding value, but with those economics, we're really confident that we're at a good spot for additional venture rounds, and it's healthy business.
I guess, Paul, my question is, are you looking, I mean, just to be clear, you have healthy payback. For 4 months is a healthy payback period for your stage. What I'm trying to get at, are you running more and more paid marketing experiments to try and figure out how you can get more customers quicker, so that 10 grand, you're driving that CAC up, or are you staying here or going down?
Yeah. We're always trying to get the CAC down. The way that we find customers is in two ways. One is they find us through content. We publish a lot of content about data lakes, performance monitoring, visibility through a blog post or a white paper that we've written. And then we're also reaching out to customers that we know are using Amazon Redshift. How do you know that? Is there some like JavaScript scrape you do, or how do you get that list? That's a really good question, Nathan. So it turns out the word Redshift is pretty not common in job descriptions. And so if you scrape Indeed, for example, you can kind of figure out which companies are using it. So really we have scrapers that go out to job boards, and then they collect company names, and then we just sort of get lists of people that work in those companies with the right titles, get their phone numbers, and just basically do cold outreach.
Really smart. Is that how you got your first dollar when you were 6 months in?
A little bit. We also used our network at that stage, because Lars and I have been in the Valley for 20 years, so we know time. So we do start signing up early alpha users to a not fully baked product super early on. And so the first few customers were largely Founders Network. That's great. And I assume today, since you just raised that capital, you're obviously not break even or cash flow positive. You're still investing and burning capital right now. True. Yeah, we're investing in R&D. Our biggest cost is engineering and software development. Our goal is to raise another round of funding about this time next year. Would you ever, Paul, consider, I don't know if this is popular in the Valley or not, because there's so much VC money out there, but I mean, have you looked at venture debt at all to basically fuel growth without having to take dilution? Yeah, we're not able to do that yet, because venture debt, the banks that we work with only give you venture debt if you're after a Series A. You're talking about like SVB or what, Square One? Yeah, exactly. Have you talked to I'm talking about people that play lower down the ecosystem. So for example, Lighter Capital will go like pre-VC as long as you're north of like 15 grand a month in revenue. I mean, have you talked to folks like that or no? Not yet. Yeah, we haven't had a need to, but I think venture debt is a great idea. And I'm going to look at seriously doing it next year, just because it's another financing option without giving away equity. Oh, totally, man. I love it. I mean, obviously capital, it can be a little expensive, but again, if you understand your growth levers, I'd rather keep the equity, Exactly.
Yeah. All right, cool, man. Let's wrap up here with the famous five. Number one, what's your favorite business book?
Good Strategy, Bad Strategy by Richard Rumel.
Number two, is there a CEO you're following or studying?
I really love Lou Cerny at New Relic.
Number three, what's your favorite online tool for building your company?
Gosh, I log into Heap Analytics a lot to keep tabs of our metrics.
All right, good one. Number four, how many hours of sleep do you get, Paul?
7.
That's good. And which situation? Married, single, kiddos?
I'm married with a small toddler and one on the way. And so it's shocking that I get 7 hours of sleep, but our kid thankfully sleeps through the night for now.
That's good. All right. Married, one kid, another on the way. And how old are you?
Yep. I'm 42.
42. Last question. What do you wish your 20-year-old self knew?
To have kids sooner. It's awesome having kids. And, now that you have some, you kind of want it. Yeah, I wish I had them a lot sooner than now. But yeah.
Guys, have kids sooner. Launched Intermix back in 25, again, giving visibility into data pipelines, working now with really an enterprise segment as they're growing, working with 25 customers, call it a 50,000-ish ACV. But anyways, they're flirting with in the next couple of months about $1 million in terms of ARR. That's up from about $30,000 a month just a year ago. So healthy, more than doubling year over year. Burning capital, they've raised $5 million, 9 people in San Fran, New York, and Europe. Less than 5% annual revenue churn, but more than 5% expansion as well. So 100% net revenue retention annually, spending up to $10,000 to get a new customer. So healthy payback period as they look to scale. Paul, thanks so much for taking us to the top.
Thank you, Nathan.